The market is at all-time highs. All-time is a long time, as they say. So what's going on here? Why is the market up as much as it is? I have a lot of people who are messaging me, and they don't seem to really understand. So let me break this down to you. First and foremost, if you ever read my profile on Twitter, I am a trader that combines technicals, fundamentals, and macro. I blend all three of them. And in this instance, you have all three working in the market's favor. So I think I've been pretty detailed about this, but I know not everyone catches all of my videos, or they get ideas of their own. But the story here is what everyone is talking about, is the Trump trade, the rally. And that consists of deregulation, tax cutting, and really repatriation, and a pro-growth agenda. Those are the sort of the four legs to the stool here. I think a lot of people didn't get that, or they don't understand that the situation, the economic situation that the U.S. is in, has been improving, as has the globe. You've had some decent numbers out of China even last night. And that is really what's been fueling this move, the return to growth. For 8 years or so, we've had an administration that was more into entitlements and dependency and sort of villainized success and growth. And I'm not trying to get too political here, but that is really the truth. You can hear it from the CEOs. I've seen them on TV, and you could even see what they write if you ever read any of their op-eds. Anyhow, the situation now is the growth, and the macro backdrop is growth is accelerating. Fundamentally, you have the deregulation, and that's why you've seen a lot of this move in the banks. I think the fact that interest rates are going to be rising, or have been rising, is also good for the banks, but I think they had been neutered so badly under the Obama administration with some of the regulations that had been put into place that there was really nowhere to go for them. They were basically utilities, wards of the state. And now, if there's a repeal or a partial repeal of Dodd-Frank and some of the other regulations that have been put in with financial regulation, that will make these banks profitable again. And you've seen this in no small part for the move in the banks. I mean, they've been off to the races, and they were up again really big today. So I had, for a while back, said that if you want to play for higher interest rates, the best way to play it was with the insurance companies, because they actually had a ability to make money. But now I've said for a while the banks are back. They're back, baby. With regard to the banks, JP Morgan in particular, I've been saying for a while I thought this stock was going to go to 100. Short term, we've doubled the range into the 93s. I had talked about this in, I don't think this weekend review video, maybe I did, but the week before for sure. And we are at, we're actually above the main channel and into the higher channels high. So I'm a little cautious. I don't really love chasing, but people were saying, oh, you know, these things are so overbought. You've had now 1, 2, 3, 4, 5, 6, 7, 8, 9 days of consolidation, and the 20 MA and the 50 MA had caught up quite a bit. So not as overbought as you might think. I'm a buyer on pullbacks on the financials as long as they hold their 50 MAs. Let's talk about the aforementioned rate hike. So in my last videos, I've been saying that I thought that there was a risk of I woke up and I didn't realize that I have a test tomorrow type of scenario with regard to interest rates. But the market now seems to be pricing in a move for a rate hike for March. I had looked at the Fed minutes of the last meeting, and they didn't indicate that they were looking to hike, in my view, this in this cycle. You've had some subsequent tough talk from the Fed governors that has led the market to believe that they may be looking to hike interest rates. So I think the Fed may or may not take the opportunity here to hike. If you look past March into May and June, the May hike, they have the probability up pretty high too. But if you go out further, June and July, it seems to simmer down a little bit. So I realize that the market is factoring in a rate hike. And I think the Fed may say that they think they can get away with it here, but there are a few pressing matters that are coming up. In March, there's going to be a debt ceiling, probably fiasco, a showdown with the Republicans and the Democrats. I believe that's the 15th is the deadline, so somewhere between the 15th and the 16th will be potential tension. I don't really expect there to be some type of default, and I think the more the market gets into this mode that it's used to this, it's sort of become used to this, right? The political rancor that's gone on back and forth between the political parties, and I think it desensitizes the market to that scenario. I've said a couple. So anyway, the probability of the Fed hiking now is about 2/3. It's about 66.4%, up significantly from like teens a couple of weeks ago. I thought that was too low. This might be too high. It may balance out as we get closer to the actual event. We'll have to see how that plays out. I don't think that the market is necessarily going to lose its shit, so to speak, if the Fed does hike, for a few reasons. The absolute number that we're coming from, the low end, where we are in rates, is very low. And the Fed, in the end, has said that when they normalize, it's only going to be to about 3.5%, potentially even lower. I'm curious to see how that's going to play out in sort of the out years if growth really starts to accelerate. But the Fed seems to be of the opinion that they've learned their lesson from raising to 6% and then having subsequent market crashes. I think that they also learned from raising too fast. They basically, the government had encouraged people to take all these mortgage loans out, and there was a ton of floating rate mortgages, and this is what led to the financial crisis. And then the Fed raised interest rates 17 meetings straight in a row. The Fed, at the most, basically, given the press conference model here, can raise 4 times a year, and they have indicated this year that they would probably stop after 3. I think that they have the likelihood of maybe raising 2 times. I don't know if 3 is necessarily in the bag. There's going to be some junk over the summer with regard to Europe and some of the elections there with France and also with Germany. That may get people nervous again, at least short term. I am a huge fan, and I was on top of this stuff early, saying that I thought Brexit and Trump would be both market positive incidents. They had the initial knee-jerk down, and then the market has been screaming up higher ever since. I was asked the other day where I thought the market would be if we had had a Hillary Clinton win. And I think that we'd probably be in the high 1900s or low 2000s. That's honestly my guess, because there would be no reason for the market to continue up other than playing this game with the Fed. And I think easy money can only go so far. At some point, you do need to have growth, and that's really what this is all predicated upon. Anyhow, let's get into the major market indices and the bonds. Let's begin with the bonds. First and foremost, today was a pretty nasty move down. You had 3 days higher, holding a gap, and then today was a nasty gap down. But there is sort of a silver lining to this situation. Today's close was still above the Fed day high. You had to look below and fail. So for a right-out trade, I like either over high of day, today long, or below the low for a short and a retest of the all-time low. I shouldn't say the all-time low, but the low of the range, the 116.80. And potentially we finally, at long last, get a primary trend touch. You know, we had stopped a little bit before then. That being said, we've just been ping-ponging in a range, basically with the lower end of TLT being like 118.33 and the high end being 123.14. Oddly, that was the day I remember I had been playing long and I had said that that was where I was looking to pull the trigger to get out, and I've never really looked back with TLT. So that turned out to be, I guess, fairly astute trading. Anyhow, how did I come to that number, by the way? And it's all in real time, time-stamped, and I had said to use anything sub 123 as a stop. It's because the 2009 crash peak was 123.15. By the way, that's how high bonds are right now. Even with this large pullback or whatever, we're basically just below the panic high from 2009. So that just shows you how low interest rates really are, and that's why I think the threat to multiple expansion might be mitigated a little bit. So that's the trade, I think, with regard to TLT. I think you could use for a right or right out play against today's range, either long or short. Was TLT on here? I thought it was. Yeah, there we go. The dollar. Now this is an interesting, I'm going to kind of weave in a little bit more TLT and a little bit more dollar because there is a lot to be said about both. First and foremost is someone was debating with me on Twitter the other day, a couple of people, and I was saying I was surprised with the rate hike probability rising that TLT was still holding together as well as it was, and I said that I thought the risk there was actually down, lower, and those people who were arguing against the fact were saying, no, the rise in interest rates is going to cause, you know, growth to contract, and that's why TLT is staying strong. That the basically that you're going to have the short part of the curve rise and the long part of the curve stay either flat or rise slightly. And I said that this was nonsense because the last time the Fed even hinted at raising interest rates, TLT completely fell out of bed. So I turned out to be correct today with regard to that argument. We'll see how that plays out into the actual Fed hike. My take on that is you can't have it both ways. The backdrop, like I've outlined for the market, if you looked at some of the economic data that has come in, it has been barn burner data with regard to like the Philly Fed. It's cooled off a little bit in like some of the reads today and some of the PMIs and stuff, but in general it's improving, which is good. I've said for a while that one of the biggest threats in my view to the market could be a very strong dollar. The Fed has also said in their last minutes that they're cognizant of that and they don't want a strong dollar, and President Trump has also said that he isn't in favor really of too strong of a dollar either. I'm looking at the pattern right now, and it is technically setting up for a potential head and shoulders pattern here, with a couple of caveats. The left shoulder, the high of that left shoulder was 102.12. If you start taking that out, it starts making the pattern less likely for right-hand translation lower into a head and shoulders breakdown. Head and shoulders tend to work best when you either have an equal left and right shoulder, or a lower right shoulder. In particular, I always love to see the lower right shoulder, like sort of a slouched pattern. And I'll say this, if you get above the head, the 103.81.5, that would invalidate the head and shoulders pattern, and I think the dollar would start screaming back to some of the levels that I had talked about with measured moves. The 2 times the range was 108.89, and another 2 times range, depending on where you took it from, would be 109.32. So that's a big possibility, and I think that if the dollar took off in that way, I'm not so sure the market would like that. So the dollar to me is still a big risk. Why is the dollar rising? For a couple of reasons. There could be the anticipation of all that repatriation, trillions of dollars flooding into the market. I think it's also a lot of foreign money coming here. Foreigners love to be involved in countries with either stable or rising currencies and rising or stable stock markets because they get the return in the market and then also the currency boost. If you're invested in a market and the market's rising but the currency is cratering, it eats your returns when you look to repatriate back. So this area in the dollar to me is going to be really, really make or break, and we're going to have to see how that plays out. I will also mention this, that I think at this point, the market consensus is that there is going to be a rate hike and that there probably is going to be an opportunity to buy some of these yield plays for some right or right out action. What's puzzling to me, and I have to do a little bit more of a deep dive on this, maybe it's because of the Kraft Heinz deal potentially with them talking about buying Unilever, but I'm still seeing a lot of these sort of safety stocks like the Cloroxes still holding very strong. I think that could be a factor in because they figure the Fed isn't going to hike as much, but now we know the Fed is going to hike and these stocks are still holding strong. The theory behind this would be that there is a recession looming. I don't necessarily think that I always am so hesitant to say that I think this time is different because it really never is. But I think that the M&A speculation in some of these names and the dividends have people speculating in terms of these stocks maybe being worth more now that they've kind of shown the cards of the Kraft Heinz deal. So I have to do a little bit more of a deep dive on that, and I have a couple of people I want to talk to about this and see what their theories are about it. But that is something to make a caveat of a note. If there were to be an early tell, this might be one of them. Oil, the curious case of crude. So we all know, we've heard it on television a bunch of times, that there is like this record open interest of speculative longs in oil, and anytime this thing seems to get close to 55, it gets slapped back down. It seems to me that it's just consolidating in a range, and I'll tell you, the more times it kind of taps on the door, the more likely it is for the door to open. I'll say this, if it can clear the 55s level, I think it's probably got the next $5 to $7 higher. If you start losing the range low now of, 50, what was the low here? It's really down even to 49, believe it or not, but I don't really think that this should be losing like 51s to 52s anymore. That really to me would be maybe a sign that there could be some issues at hand with this. So I'm sort of waiting to see how this handles itself and breaks the range. My theory on oil, and everyone keeps saying, oh, we have all these huge rig counts and there's all these speculative longs. How is this not getting monkey hammered? And my answer to that is I think it's a little bit more sinister. OPEC is doing their cuts, right? And production cuts do seem to be working. That said, the Canadians in particular have been putting on oil rigs like there is no tomorrow. The U.S. also, every Friday, that Baker Hughes rig count, although I will say the rate of change has started to slow. They're putting on less. My thesis behind this is that the Saudis are keeping oil high for their Aramco IPO. They want to bring it public. They need to bring it public. And it won't fetch a good price if oil is in collapse mode. So I think that they may even be part of that speculative long series. Call me a conspiracy theorist or what have you, but I think that the Saudis are supporting the bid. So that's a little bit of my theory on oil. Exxon finally today showed some signs of life, which was nice. Right? It would help if I could pull this chart up. It's been holding the 41 level, which is important. And I like that we actually did get an over 83 close. 83.01 had been an important level a while back. We didn't close on the dead high, but today you had a pretty nice bar. If this can start clearing, 83s, and over 84s, this may have a run back up to 86s, I would think. At that point, I would need to reevaluate, but I had said I had been starting to, on these lows, starting to sell some out of the money ExxonMobil puts. Today, I didn't even realize what a little rally could do for them, and they got murdered today, which was very nice. So now I got that going for me, which is nice. If there were to be a flush down to like the 70, somewhere between like 75 and 78, I would even say 77s. That area to me would be very, very tempting to start getting more serious about this and selling much larger size out of the money puts. And I've discussed that I thought that the reason, people always say, oh, why would you want to add to something that's a loser? And I keep saying that if that's your initial, there's a big difference if you start a position small and it's part of your business model to add on this because you're kind of fishing for the bottom, or having huge losses in full size and then looking to add up and kind of like double up to catch up. Not really my style. So that's the difference there, if anyone was curious. With regard to XLE, this has been pulling back fairly aggressive. I shouldn't say aggressively. It's actually not been that aggressive. Today was actually a downtrend. It looks like a downtrend snap. Let me see if I could draw this in any better. Well, depending on where you draw it from. If you do it from the kind of lower high, it's right to trend. If you did it from the absolute high, it's a bit of a trend break. I'm a little hesitant as long as this thing is still below the 50 MA, which is arcing down, and today we couldn't get a close above the 100 MA. So I guess I'm sort of okay with XLE on attempts for as long as the 200 MA holds. If that were to snap, I think we'd get another leg lower to the kind of old channel low. We busted out of the channel high. I mean, I can even make the case that because we busted above, this thing might even bust below and get the gap filled to 61. I mean, that's a long way off, but if you were to, you have double bottoms in here, 70.63 and 70.65, and you have a 200 MA right below there. If those double bottoms were to snap, I think you'd get more of a cascading effect in these oil names, particularly in XLE, and you probably could get another, a pretty sizable flush lower down to the very least the reference lows, which coincide with the trend line. So this is, like I said, in a bit of a consolidation range here. I'd like it either long, really above 73.78-ish, 73.69, 73.78. That area is the high of the consolidation and above 50 MA. Or I'd like it short below this like 70.65, 70.63 area. I think that will be a go with in either direction. The miners, the GDX has been getting slapped back down a bit. Today, for the first time, actually, I like the close there. You had to look below the 100 and the 50 MA and then a close above. So, and we stopped just shy of the 50% fib. I was really hoping we would get down to like somewhere between the 61.8 and the 78.6 of this range, which is like 2011 to 2130. But if we could get back up above like the 2-day high here tomorrow, like above 2342, I think that this baby could bounce more. I prefer this actually with short puts. Like if you want to start building a bit of a position, that to me would be the better way to play. I've been more bullish, if you've been following me for a while, on silver over gold, and I like how silver kind of handled itself the last couple of days. A lot of relative strength to gold. You had a big breakout actually on 2-23, and you've had a consolidation now for 4 days. So I think you could just play right or right out against the 4-day range, either for continuation higher or for a pullback lower, really to trend if you're looking for a quick short. I'm really looking more to add to this on dips. Like that would be, the trend right now would be, I mean, if it happened tomorrow, it would be just below 17. But you have a 200 MA there, which took a multiple days to kind of get through, and that had been old support. That should technically be the new support. This thing had an inverse head and shoulders, which I had pointed out. I have spectacular trade location with this thing, and it's been good. So it's been good to me. So I'm fine with booking some profits if you want to use a stop below 17.27 short term. But like I said, I'm more of a dip buyer. Even if this thing got back into the 16s, I still think it would be a buy. I'm thinking a little bit longer term with that one. So that was SLV. That wasn't on my list, but we did cover GDX. Freeport McMoran, that's sort of the, I don't know, the copper, it's sort of a copper play, although they've kind of convoluted themselves with oil assets and all kinds of junk. I shouldn't say junk, but they're not a pure play like they once were. They have a double bottom in here. This looks like, to me, a bounce back from their most recent move down. I really would have liked this to pull back, have pulled back more to kind of close the gap down to 12.04 and get a trend touch. I'd be much more interested in like selling out of the money puts there. This is a good play on economic recovery, and if the Chinese numbers are getting better and the US numbers are getting better, this theoretically should bounce. It's come down a decent amount, but you're still below an important level, 1406. You really need to start seeing this thing firm over 1406 for a move higher. But I'd be interested, a more interested buyer lower, like in like the 10s and 11s, if it were to get down there. Particular, I think the 12 actually. I'm looking at the, just looking at this chart. If that was really a big, that was really the breakout. So if this were to get there, I'd be interested in a, particularly if it happens soon, I'd be interested in selling some out of the money puts, like maybe more like mid-range level, somewhere between like 10 and 11 puts. Someone asked about this Blackstone, not one that I follow very often, the Blackstone group, right? BX. This looked like it has a bit of a, I don't want to say a rounded bottom, but it looks like it has a pretty well-forged bottom. If this can hold over 28.56, I'm kind of okay with it. They have it short term here. If you're really a short termer, you have a bit of a head and shoulders pattern on the daily from this most recent run, this gap in area. I just think this is a bit of a consolidation, and I'd probably be interested in buying the dip in this if this were to have some type of a move back down. I'd be probably more interested in a 200 MA touch if this were to like have the right-hand translation lower. So that's my kind of take on this. This tends to come in fits and starts. So yeah, I'd be more of a buy the dip player. I can't tell you if this is going to have the larger pullback or if this is going to be just a consolidation from the gap. It looks like to me it's really honestly just consolidation from the gap, because you had that run up, this violent move down to kind of retest the breakout, and then it ran again, like almost on a semi-professional gap. Actually, it did kind of turn out to be a professional gap. So, I mean, I would think that this is probably a buy on dips. I'd like it around the 200 MA if you can get a move down that low. NVIDIA kind of bouncing around a bit, right? So I really would have liked to have seen this come down a little bit more before. Like, I would have liked to have seen this kind of shake out some more of the I don't know, yips, I always call them. I come up with all kinds of, like, I call them yips because they're kind of like the yippee crowd. They get really excited when things, you know, when things move. So you had a bit of a move in the range. You had a look above and fail, and then you had a move down. Usually when you have a look above and fail of the range, and I'm using 99.38 to 119.93 as my range. So we had a little look above there and fail. So of course we came down to the lower end of range and then had a look below and fail. So if you could hold 99.38, I'm still kind of, I'm still okay with it. If you start losing that, you probably want to bail, and it's probably going to have some range extension lower. And then, you know, that people will probably be talking about a confirmed double top and potentially, you know, be looking at the gap fill down to 67, 77. I don't know if that's going to be the case, but I'd probably be interested in selling some out of the money puts somewhere in the mid 80s. So that's my take on the NVIDIA. Tesla. So Tesla ran up. I think the problem with Tesla is it basically had a similar measured move. It ran up, pulled back. It's held the like 4085 is a big level to me, and it didn't even quite touch the 50 MA. It had the bounce back up over trend and now is sort of just consolidating. Today was a little bit of a disappointing day, I would think. I'd be more interested in honestly buying this thing on a pullback to like the 200 MA area. If you're aggressive now and you want to kind of play it the chicken hawk way, maybe sell some near dated out of the money puts that are either at the 200 MA or below it. The 61.8 of the range is roughly below where the 200 MA is. That's 221. I would think in that area there's a lot of kind of price memory. The 213.70 and like 215 area there should be a lot of price memory between like 221 and 215. So if you want to sell some out of the money puts, that would be the area. Those strikes are below those strikes. I do think that there will be a lot of muscle memory down in that area if you want to kind of play it the chicken hawk way. We covered the dollar. We didn't cover SPY yet, but we will. So someone was asking me about this Visa. Yeah, this has been on quite a tear here. This is, of course, the play of people looking to switch from cash to credit card. It's an interesting move today. I would say this: it's probably a little late to first chase this on the long side. This may have $100 written on it. I mean, this could happen. I'd have to do a little bit more analysis of like range doubling and things like that for my taste for this, but it's obviously bullish. If you were to have, like, let's say tomorrow, a move below today's low, 88.42, I think that would be a good setup for a right or right out short, particularly if it happened in like gap and go fashion, because today could mark a potential interim high. I don't know how far this thing would pull back to, maybe the breakout in 83 or 82, which was the gap fill, but this to me seems like it's you know, on the move for, you know, it's obviously higher. I'd be into buying a retest of the breakout, which I said was between 82.30 and 83.96, but as long as, you know, the trend holds, just draw a little trend line, you're you know, it's going to be a buy the dip situation. The only, like I said, I'm not in favor. I always have to ask myself, do I have good trade location? And I can't say that I do for this. The time to have really longed up on this was over 86.82, which was the gap up high of day, and anything usually over those high of days after a few days of consolidation tend to continue running in that direction. So, I mean, if you want to buy a pullback, maybe you could try right or right out at like the 20 MA or so. But like I said, I don't feel like I have good trade location here. It could go higher, but it's going to have to kind of do it without me. And I'm sure it will. The stock looks like it's pretty good. For a right or right out trade, though, below today's low, you could just set a sell stop in there and try it for right or right out, and then use the high of the day as the stop. Ambarella. I don't know what the heck this is. Oh, this is Ambarella. Oops. All right. So they reported right, and they had a kind of junky number, I guess. They went down. They closed below the 200 MA. So I thought that this might have a little bit more bounce to it, to 64s, which would have been the 50, not the 50% fib. That was sort of the backside of the old uptrend channel line. So we'll keep it simple, really simple. you have an earnings day range today, right? So long above it or short below it. My guess, though, and I'll say this, is that the 50 MA was a really key level. That was where this really had first broken down from. And then moves above it were unsustainable. Now we are sustainably above it, and you have a turning 50-day moving average. So if you're aggressive and you want to try long, I'd be fine with trying a right or right out long on the 50 MA with a stop, on a close below there for sure. Yeah, this to me just looks like a lot of chop and consolidation in this name. It ran up a lot into earnings, so it's getting a bit of a pullback. Yeah, 50 MA, as long as it holds the 50 MA, I think you could kind of try buy the dip. But if it loses that, I would just kind of stay away. All right, let's get into the major art market indices, and then we're going to kind of wrap her up. So the big question of the day was today kind of the blow off top. I don't necessarily know that. We had a poor high today, by the way, and I think you had a little bit of selling into the close, which is a bit of a liquidation break. And the must go home crowd, go home flat crowd kind of came back from lunch, I guess. The market isn't as overbought as I think people think. Between 12-13 and really the breakout of 2-3, there was a ton of consolidation. Then you had you've had these multi-day consolidation, and we just broke out of a 1, 2, 3, 4, 5, 6 days worth of consolidation. The 20 MA is getting close to it's really we are extended. Don't get me wrong, but it's not as egregious as you might think. I would say this: if you broke today's low of day tomorrow, you could try a right or right out short. But all else is just guessing at this point. I've talked about a few projections for upside targets, measured move. I had the 229 a while back. Then we had talked about 234.03, which is the 1.618 Fibonacci extension of the entire bull market range. We're above there. Often I find that you can get above. Then I had talked in my last sort of projection here would be 2 times the range of the 2007 high to the 2009 crash low. If you take that range and just double it, you get to 247.94. So that would be my kind of the last technical upside level that I'd really feel comfortable projecting to. Sometimes these big round numbers like 240 can be trouble for a while. I still think that the market will be in buy the dips mode, at least on the first pullback of any major pullback. Before the market's in really major danger, stranger danger, I think you need to see it rally to, first of all, you need to come down. You'd have to have some type of a correction, and then a rally to a lower high that rolls over and then takes out the prior swing low. Once you see that, by the way, the top is probably in. We have not even come close to seeing anything like that yet. So that's my take. I also think any pullback initially should target a 50-day moving average at the kind of the max. And then I do think that the 50 MA will likely be bought at least the first go round on any major pullback. So what I would suggest doing if you're long is just keep trailing up stops and using prior day lows as a stop. And if, like I said, if we were to lose today's low tomorrow, there could be a right or right out short, probably for a gap fill. It might even go lower to the backside of the old channel. We're now trading on the wrong, sort of the upside of the channel. And notice what I've said before in the past about what happens, the behavior of markets when you get on the wrong side of or the other side of the channel. Pullbacks to the backside of that wrong side often are a buy, almost always are a buy the first time, and then there's a throwback higher, and that's when you usually get your lower high and down. So that's sort of what I'm looking for. So if you're looking to play this, I've mentioned a few ways to play this. I mean, the money flow index is sort of in the overbought territory. Stochastics are, listen, we all know the market's up a lot. It just is what it is. That doesn't mean that the market can't stay high longer. There is no overhead supply here. This is an all-time high. So there are no dead bodies above us to kind of come in and spoil the fun. It's just sort of a technical level, and maybe there's some type of an event that spooks the market. Apparently the Fed wasn't enough for it today. I've talked about a couple of scenarios here about how the SPY could trade and how this story could end. One would be this, is if we do get some type of a blow-off, continued blow-off move, and I would say when the market starts having these big gap ups and these bigger body candles, that's usually the end of a move. The same thing on the downside, when you start getting very steep and the bodies get very big and there's tons of panic. Amazingly, I still don't think that we have a euphoric market. I was just looking through my DMs before I came on air, and I guess I hadn't checked them enough, but I had people asking me about, which indices should they be looking to short, and what do I think of this short play or that short play? I mean, these aren't usually the questions you get when the market is, kind of in full euphoric mode. It's like, how long will it take for the next 10 points to be higher, or, with crazy upside projections. That has been the sort of the exact opposite of the case here. Not really a euphoric market. Just need to plug my charger in here. My phone is dying. I thought I had it in. So that's sort of my take on the market, that you kind of, if you're looking, like I said, for some type of a short action, let the market kind of tell you. Don't kind of pick tops. Like I said, a loss of today's low would be a good entry for a liquidation break pullback. That's SPY. The IWM is nowhere near the real true channel high, and has been lagging and could potentially, that may be the one that has possibly the most upside if things really went parabolic. The 1.618 fib extension of that range is 150-101. Channel high right now is 147. This sort of has been underwhelming, right? It's sort of just like futzing around on the other side of the breakout. So yeah, I mean, I think that this play, if you do get the dollar firming up again, you'll start seeing, like, if you wanted to play on the dollar breakout and you don't play dollar, IWM might be your place to go, because that's the domestic companies that don't have to worry about repatriation and overseas profits being crimped by a strong dollar. So keep an eye on that. Conversely, if the dollar were to kind of start breaking down, you might see more outperformance in like stocks like in the S&P. The Qs, which everyone seems to want to be for some reason short, because this thing has been moving like a mofo. The 1.618 fib extension is 132.71, so she's getting kind of close. I think it's going to be real tough to crack the tape, as long as you have like these, as long as you have stocks like Apple that are just like in beast mode. This thing was just up a lot today. Usually when you start getting the moves of like multi-points, that gets, like I said, a little closer. But if you were to do a 1.618 fib extension of the entire Apple move, that's 162.39. The 1.272 is 146.80. I'm a little leery because we came up from the bottom in the 90s. We're well above the channel high, and the reference high was 134.54. I mean, it just seems to me that it really is impressive that this thing was able to break out and continue going even at, like, I had thought that the danger here was a bit of a look above and fail, and I mentioned that on the 215 day, but I said the only entry of short would be below that low, and we never took it out. So there was no short entry. Same thing, again, if you were to lose like today's low on tomorrow or the next day, you could try it for a right or right out play. But I mean, we're talking about for like a pullback to the test of the backside of the old channel, which is like 131. So that to me would be an entry. I think we could wrap her there. We've covered a heck of a lot. I keep getting messages and people asking me about why the VIX is rallying on days the markets are up or what have you. because it can't go any lower. It's at a low, right? I mean, the VIX doesn't really get or sustainably below $10, $11. Also, if you have a speculative orgy taking place, the VIX could rally on call buying. It's usually associated with fear and people buying puts, but if you do get yourself into a situation where people are caught short, and I know, I'll tell you, I have a litany of people I know that are caught short and fighting the market. I always am curious to hear when they kind of wrap it up and throw in the towel. I assure you many of them have not. What they do to hedge is to buy calls. So I think you have a combination of speculative call buying, probably hedging or outright speculation of put buying. And, at all-time highs, near ends of month, people are buying puts. That being, to hedge portfolios. That being said, if you start getting a move that sustains over the 200 MA, which really isn't very much from here, right? I mean, this thing has been slaughtered down to 1376. That could be a more sustained move. I'll tell you, I actually was quoted in I think it was a CBO, CBOE or a CME. I think it was, I forget which one. I have to look, but I was quoted, and there had been somebody who had wrote an article and said that the VIX is, this was a couple of years ago, and they were saying that the VIX is below these lows and that it's due for a big rally. And I said, if you take out the crisis period, the 2008-9, if you take out that like huge spike in volatility, the VIX is really trading in its true range. And then they made an amendment to the article and they quoted me on it or whatever. So having a low VIX for a while is very possible. Temporary spike ups are okay. The problems become when you have fundamentals changing and you have a VIX, starting to really break out. I sort of almost feel like the VIX it's a question of the tail wagging the dog. I think a lot of people have assumed that the VIX being in the low end of the range means the market has to correct, but it's more that the market corrects and then the VIX goes. So just keep that in mind. That being said, the VIX is starting to make some higher lows, a little bit of higher highs, and I'm always mindful of that price action. Today you've now had 3 days with closes over the 50 MA there. If you want to play the VIX, I don't like playing those levered ETFs. I think they're crap. I don't like buying VIX options. They tend to be pricey. What I do like to do is to buy SPY premium. If you want to play the VIX, if you want to play for that move, play the SPY put spreads. What I've been doing, and I've affectionately coined the phrase the green room plays. So whenever you hear me talk about that, that's really what I mean. I've been doing put spread overwrites, meaning I buy long dated put spreads and sell more near dated extra puts still further out of the money to make up for that premium. If you're not comfortable with doing calendars, you can just buy that put spread and then just sell an extra downside, group of puts. The example that I gave, I was saying that I've been making so much money on these overwrites, it hasn't really cost me very much to have this position on. So like, for example, I did in May, I did 234, 225, and then I wrote in April the 210s, as an extra overwrite. So the reason why I like the calendar with the more near dated, with the extra put, the overwrite being in a more near dated strike, is if the market were to have a big move down, I'd be under pressure immediately on those overwrites because of two factors. One is the delta and the gamma risk, meaning as it accelerates, my gamma is gonna start jumping. And I'm also going to be under pressure volatility-wise. The VIX is very low right now, and I'd have a lot of vega risk, meaning those puts, the extra overwrite would balloon up. That's far out enough as far as strikes go that I don't think that they're really going to ever come under serious price pressure. It could happen. You never know. But what I do know is that the structure of the time, if they do come under pressure, what I could do is buy them back and sell further out of the money, either in the same series or in a longer dated series. So I'm giving myself time to play with it, and I could add size. I could do lots of stuff. So that's the sort of the way I've been talking about it. So someone asked an interesting question to me on my risk management video, and I wanted to share my answer with everybody, because I think that this is an interesting this was an interesting question that warranted being discussed. I don't have it in front of me, so I'm just going to give the gist of the question and the gist of my exact response. So it won't be the exact question or the exact response, but this is basically the question and how I answered it. So someone asked me about why do you take profits along the way, that if you're selling at any point, why don't you either just clear out the entire position or don't take profits along the way and hold? Because there's a risk in not being in a position, either long or short, for the max amount of the move. That is very obvious. Of course, there's risk if you're out of a trade as well. The problem is that we don't have perfect information ever, and you never know where a move is going to theoretically end. All I can say is, based on probabilities at certain points, either previous reference levels, horizontal levels, or Fibonacci extensions or Fibonacci retracements, I know that there is a probability of some, or gap fills or key technical levels. So let's say, for example, I bought a dip in a stock and it stopped at the 61.8 Fibonacci retracement, and I'm playing for the gap fill. When the stock gets to the gap fill, statistically, it could have a pullback. I don't like it as much anymore at that level. Do I hate it? No, but I do book the whole thing at that price. But let's assume I think that the stock could go higher. Something has changed, or maybe we only get to the 38.2 bounce level, but I'm looking for the 50%. So I would book part of it at the lower 38.2 Fibonacci retracement, and then look to carry the balance to the higher level. I always say the best risk management is at order entry, but as you move along, the probability of something happening becomes less, and the way I mitigate that risk is with size. So that's why I like taking profits along the way. If you're not in the take a profit along the way, full-on gambler mode, which I would not advise to, at the very, very least, hedge it with either put spreads or selling out of the money calls, or both, or in my view, use a trailing stop. That will save you a lot of heartache, in my opinion. Anyhow, that's my story. I'm sticking to it. I think we had a pretty productive session. If you missed this or you caught it late, it will be on YouTube shortly after. It just saves, and then it like buffers or whatever, and then it or processes, and then it'll be live. So if you're not following me, subscribe to my YouTube channel. You may have to create an account. You'll get notification. There's a little bell with a plus you can hit, and you'll get notifications when I go live on this. I never post any videos on YouTube other than weekend review videos, these live videos, or a specialty video about trading. So you're not going to see me walking a dog or something. So feel safe that the notifications will be relevant. Anyhow, that's my story. I'm sticking to it. And I'll see you on Sunday and on the stream. Cheers.